Thanks for joining us at this Magellan update. Today I'm speaking with Magellan's co-founder, Chief Executive and Portfolio Manager, Hamish Douglass. Hamish, your thoughts on QE are well documented. What are your current observations around the US economic recovery?
Well, we're actually pretty positive on the US economy. We're seeing a number of very good signs that the US economy is really starting to grow, and the growth is probably accelerating. This year we've seen quite a large fiscal drag. Early in the year they increased payroll taxes, and of course we had the sequester out of Congress, which has probably taken off maybe 1.5 to 2% of GDP growth this year. The economy's going to grow at slightly less than 2% this year. When that drag comes off next year, and with some of the economic indicators I'll talk about, we think we're going to see an accelerating growth scenario, and we think it's very likely it's going to have a 3 in front of it in 2014. And why are we positive about the economic outlook for the US next year? It's not just because some of those fiscal restraints are coming off the economy. If you look what's happening with average weekly earnings at the moment, they're starting to increase for the very first time. Mortgage debt in the last quarter rose in total for the very first time since 2007. Automotive sales hit an annualised rate of 16.4 million in the last quarter. That's the highest since February 2007. House prices, they're up by over 13% year on year in the United States. If you look at housing construction, at its low, it was about 479,000 starts back in April 2009. The latest data we have is nearly 900,000 new houses are being constructed in America this year. That is still below where they should be running at, probably about 1.4 million a year, so we've still got some way to go, but the momentum with house prices and housing construction is certainly starting to pick up in the United States. If we look at the employment situation in the United States, we think there's some very encouraging news. Non-farm payrolls are actually running in the last 3 months slightly under 200,000 a year. That's nearly 2.4 million jobs are being created per annum now in the United States of America. If you go back to the depth of the financial crisis, probably in around December 2009, there have been 8 million new jobs that have been created in America over the last 5 or so years. The total number of employed people in America is now 144 million people. The peak in July 07 was 147 million people. So we're nearly back to the peak employment situation in America. Of course, the population has grown, and that's why the unemployment rate isn't back at lows. The unemployment rate's down now at 7%, but it was at over 10%. So we're seeing some very encouraging signs happening in the employment market in America. So overall, with the data we're looking at, we're starting to see some very encouraging signs. And as I mentioned earlier, once the fiscal drag starts to come off and the budget deficits are falling, this year it's probably going to be up 4% of GDP. Next year it's going to be materially less than 4%. So the impetus of Congress to make further budgetary cuts is receding in the short term. They've got long-term fiscal issues, but the short-term need to make further cuts is greatly receding, and therefore we're pretty optimistic with these signs that we're probably going to start to see some exit velocity with the US economy. And so we're pretty optimistic looking out the next 12 to 18 months what the US recovery looks like.
Hamish, your comment on the unemployment rate, there are some economists suggesting that the participation rate falling makes the unemployment rate actually not as good as what it really looks. Can you comment on that?
It's true, it's factually true that the labour participation rate in America has fallen since 2009. In 2009, the participation rate was about 66%. It's down now to slightly less than 63% in America, so it's dropped. So the call from some economists is the only reason the unemployment rate has fallen is because the participation rate is falling. But as I quoted you, 8 million new jobs have been created. We're 3 million short of the all-time record of number of employed people in America. So it's not true to say there's been no employment in America over the last 5 years. We know that there's 200,000 jobs a month being created, and that's more jobs than you need to keep up with the population growth. But if we look at the participation rate, what people don't mention when they quote that statistic is the participation rate actually peaked in 1997. In 1997, the participation rate was 68%. So over the 10-year period from 1997 to 2007, it fell from 68 down to 66%. And the reason the participation rate had been falling is because of demographics. People are retiring in the US economy, and as people get older, they don't participate in the workforce. So it's the ageing of the population. If we extrapolated that same trend from 2007 to today, the participation rate probably would have fallen from around 66% to maybe 64.8%. So the participation rate is naturally coming down anyway as the population ages. Yes, it's lower than it should be because people have probably been forced into early retirement in this deep recession. But the good news with the latest statistics is that participation rate seems to have stabilised, which means this job creation is genuine. And so we look at the statistics. So yes, people have quoted that the US economy actually isn't recovering. All this is a fake recovery because the participation rate is falling. I would caution people, this recovery in America is real, and we want to participate in it.
And your view on the timing of the tapering of QE?
Yeah, I'm not sure if the timing of QE tapering is really the right question. It is inevitable we're going to stop purchasing $85 billion a month of bonds and mortgage-backed securities in America. But whether you're purchasing $85 billion or $70 billion, you're still purchasing. So whilst there'll be some volatility around the tapering of slowing down purchasing, that really isn't the big effect. The big effect is when you stop purchasing. And that's what you really have to ask the question, when is that going to happen? There is a debate whether the tapering is going to start now in December, into the first quarter 2014. I don't think much really turns on that. I think with the economic statistics I've been talking about, it's inevitable we're getting to that day of reckoning when bond purchases are going to slow down. But what people need to focus on is what is going to happen when bond purchases stop. And the faster the US economy grows, the quicker that day is going to come. And there are risks attached with that end. I think people are very quickly going to move from this tapering discussion to what's going to happen when QE ends.
Hamish, any update on your thinking around the European economic recovery?
We remain highly sceptical that Europe is going through any form of strong cyclical recovery. Where we can see some positive economic news out of Europe, but I think you need to not confuse between sort of a stabilisation and a fact that you're suddenly going to have a cyclical recovery in Europe. What's the positive news? Many of the periphery countries like Spain, Greece, Italy, Portugal, Ireland, many of these countries were running large current account deficits. They're now all running current account surpluses. That's no doubt good news. Budget deficits are falling. They're still in deficit in most of these countries. Government debt is very, very high. Governments have very limited firepower to respond. The banking system, in our view, is still well undercapitalised. And why is that a concern? It's of course a concern if there is a major external shock, such as a bond market crash at the end of QE. We're not saying that's going to happen, but it's not implausible that could happen. The banking system in Europe is very vulnerable to that. So what do you do about that? You're going to have to rebuild capital buffers. You could either do what America did, and you could get the government to inject enormous amounts of capital into the banking system. Germany simply isn't going to sponsor that course of action. So the course of action that Europe is taking is a very protracted course of action. Banks are going to have to shrink the size of their balance sheets. If they're not going to raise new equity, the only way your capital ratio's up is effectively to shrink your asset base. If they're shrinking asset bases in the banking system, that means banks are not lending, they are deleveraging. And if banks are deleveraging for an extended period of time in order to build these capital bases, it's going to be very difficult for Europe to have a cyclical economic recovery at the moment. So we would really say that Europe has steadied. Some data is looking better. Periphery countries, if you look at labour wage rates, they've fallen very materially over the last 5 years in Greece and Portugal and Spain and Ireland. That's good news. But the fundamental drag is going to be the deleveraging of the banking system. And governments cannot take up the slack because they are overstretched. These governments and countries like Germany are not going to lend these countries any more money to effectively stimulate their economies. So we would caution people about backing a cyclical recovery, a bit like what's happening in the United States at the moment. We are backing that cyclical recovery because it's real. There isn't a real cyclical recovery happening in Europe. They have years of prolonged subpar economic growth ahead of them. And there are material risks in Europe if there's an external shock in the world.
So I take it there's no immediate intention to increase the portfolio's exposure to European domiciled businesses?
Well, we really have to distinguish between European domiciled companies and European companies that may be cyclically exposed to what's going on in Europe. We have no hesitation about buying large multinational enterprises that are domiciled in Europe. If for some reason they were trading at cheaper prices than could be bought in America or somewhere else, we have no hesitation in buying them. We own Nestle and we own Unilever and we own Danone and we own Sanofi and we own Novartis. We own many European domiciled multinationals. But what you don't find in our portfolio is European cyclically exposed companies. And there are many investors who are believing it is the right time to buy European cyclical exposure. And if you look at European banking stocks, many of these stocks have gone up materially in the last 6 months or so. We're not participating. We don't think Europe's on the verge of a cyclical recovery at the moment. And secondly, we think there's a lot of risk. There is still a lot of external shock risk in the world. And Europe is very vulnerable to that shock risk at the moment. So we have decided not to participate. Notwithstanding some share prices are going up in Europe, our job is to preserve people's capital. And as Warren Buffett, I think, gave very sage advice once, he said to finish first, you must first finish. And we simply don't want to take on that risk at the moment.
Hamish, and just a quick snapshot on the portfolio?
Well, the portfolio, we're actually pretty comfortable with the portfolio. We do have to be realistic. Markets, in US dollar terms, the world market's gone up by 26% in the last 12 months. So that means many stocks around the world have become more expensive to where they were 12 months or so ago, and there's quite a lot of our defensive portfolio that is more expensive, and it's harder to find a lot of excess returns in the defensive part of our portfolio. We're very happy over the last 12 months that we have slightly decreased the total holdings. We used to have 50% of our portfolio in that defensive portfolio. We now have 40% in that defensive portfolio. We have sold many of the investments that have become more expensive where we don't think we can get excess returns, and we've found a few other things, maybe with a few warts on them, where we think over the next 3 or 4 years we can still get pretty satisfactory returns out of our defensive portfolio. You know, we own shares in Target, a retailer in the United States, and we own shares in Tesco, the major UK retailer. Both of these companies are going through a difficult short-term scenario for different reasons. But when we look over 3 to 5 years, we see pretty acceptable returns and probably some excess returns from what we look from that style of that part of the portfolio. Where we've rotated the money over the last 12 months out of that very defensive portfolio is something we regard as fairly asymmetric, and that is being into deep value large cap technology stocks. The two big public positions we have that we've made over that period have been into Microsoft and into Oracle. The interesting thing is that's about 10% of the portfolio, which is really the rotation we made out of defensives. The nice thing about them, we think there is a lot of downside protection because these businesses have been trading at very, very cheap prices because the market's had a view around some structural issues occurring. For Microsoft, it's really been the trend away from the PC and the Windows operating system into the new tablet world. We're obviously looking through that part of Microsoft's business and seeing how we think it's going to play out over the next 3 to 5 years. And we're pretty optimistic that the returns we're going to earn in Microsoft will be more than satisfactory. And if there's a shock in the world, there's a lot of downside protection because these are fundamentally cheap. And it's a bit like Oracle, where there is a big debate around the impact of cloud computing on a business like Oracle that is predominantly on-premise software for databases. Again, we have a view about how that's going to play out over the next 3 to 5 years. And at the prices Oracle is trading at, we think there is limited downside risk. But we also see very satisfactory returns if our view of how this cloud-based world is going to play out for Oracle, if we happen to be right on that, we think we're going to earn more than satisfactory returns. The rest of the portfolio is pretty core to what people have come to expect from Magellan. We still have a large investment in the multinational emerging market consumer space. It's not as large as it used to be because much of that's more expensive than it used to be, but it's still a core holding at slightly less than 20% of the portfolio. Businesses like Yum Brands and McDonald's and Nestle all play to that theme. We still have our big investments in the great payments companies in the world, or as we've termed this, the move to a cashless society. Businesses like Visa Card and MasterCard. Owning eBay gives us ownership of a business called PayPal, the world's leading e-commerce payments platform, and we think one of the leading electronic wallets of the future. And of course, then there's American Express. All of these businesses are very, very well positioned for the future. We have made fantastic returns over the last 3 to 5 years in this space. We still see very good returns looking forward. I've mentioned the tech investments we have, and of course we've got some investments that are still leveraged to the US economy that I spoke about earlier. We've got banking investments, Wells Fargo, US Bank Corp. We've also still got our investment in Lowe's, the home improvement retailer. Housing starts are at 900,000. We think they're going to go to 1.4 million. We still think they're very, very leveraged to that part of the economic recovery story. So from a portfolio point of view, notwithstanding markets are up by over 25% in the last year, we've made some changes to the portfolio. We're still very comfortable about the portfolio's return characteristics, but most importantly, we're very comfortable about the risk characteristics and believe that the portfolio will do well relative to markets if we get an external shock. And we simply will not chase short-term returns in this environment where things are becoming more expensive.
Thanks, Hamish.
A pleasure.
And thank you for viewing. We wish everyone a very happy and Merry Christmas, and we'll see you back in 2014. Thank you.